Landlords are rushing to offload properties, and prices across the south are crumbling fast. Once untouchable postcodes are now flooded with listings, desperate sellers, and price cuts every week. The pressure is real. Soaring mortgage costs and shrinking rental profits have sparked a wave of panic sales. From London's prime zones to coastal hotspots, prices are falling, and buyers suddenly hold all the power. These are the 15 UK areas where property values are plunging right now. Quick movers are locking in deals before the rest of the market wakes up. Brighton, once one of the UK's most resilient coastal markets, is showing clear signs of strain in 2025. According to Property Investor Today and Zoopla, the city ranks among the highest in Britain for listings cutting prices within 30 days of going live, a key indicator of falling buyer demand and oversupply. Many landlords who benefited from the post-pandemic rental boom are now pulling out due to higher mortgage costs and tighter yields. Average price reductions are appearing across terraced and semi-detached homes, with agents reporting multiple cuts before sales complete. Although Brighton remains popular with commuters and retirees, affordability has hit a ceiling, and first-time buyers are struggling to secure financing. Zoopla's data also shows modest year-on-year price declines, a trend expected to deepen as investor sales increase. Once considered a safe coastal investment, Brighton is now a test case for how quickly sentiment can turn when buyers step back and landlords rush for the exit. The UK's second city, Birmingham, is leading the charge when it comes to rapid price reductions. Data compiled by Property Investor Today shows the city sitting at the top of the table for homes cutting asking prices within the first 30 days of listing. This early discounting reflects growing caution among buyers facing high mortgage rates and stricter lending criteria. Many landlords who expanded aggressively during the low-interest era are now unloading stock, pushing supply far above normal seasonal levels. Areas such as Edgbaston, Selly Oak, and Harborne have seen family homes relisted with multiple price drops as sellers chase limited demand. While Birmingham still benefits from strong rental demand, its investment yields are being squeezed, prompting more owners to cash out. Agents report that realistic pricing is the only way to secure viewings. With inflation cooling but rates still high, Birmingham's property market illustrates how quickly a booming regional city can cool when credit tightens and confidence fades. Leicester has joined the growing list of UK cities where price reductions are spreading fast. According to Property Investor Today, it ranks among the top areas for homes being discounted within the first 30 days of listing, a clear sign of overpricing and waning demand. Sellers who entered the market with optimistic expectations are quickly realizing buyers now hold all the leverage. Higher borrowing costs have priced many locals out, leaving properties sitting unsold for weeks. Estate agents report that discounts between 5% and 10% are becoming common before offers are accepted, particularly for mid-range family homes. Investors, too, are retreating as rental yields fall short of mortgage payments. Despite Leicester's strong transport links and university-driven economy, the housing slowdown is undeniable. Market analysts suggest that unless mortgage rates drop meaningfully, prices could soften further throughout 2025. The speed of reductions here underscores a national shift. Confidence is fragile, and sellers are adjusting faster than at any time since 2008. Even the UK's most exclusive coastal enclave isn't immune. Sandbanks in Poole, long known for its multi-million-pound waterfront. Homes have seen average asking prices fall around 3% year-on-year, according to The Times. While it remains the country's priciest coastal market, cracks are beginning to show as high-end buyers hesitate and overseas demand cools. Rising interest rates have cut into the appeal of large leveraged purchases, and many second homeowners are reassessing the cost of maintaining luxury properties amid higher taxes and insurance premiums. Agents report that listings are staying on the market longer, and even well-presented homes are accepting offers below asking. Some sellers are downsizing or relocating inland to free up cash. Despite its enduring prestige, Sandbanks has entered a period of correction, not collapse, but revaluation. The days of instant bidding wars appear to be over, replaced by quieter negotiations and cautious optimism that 2025 will stabilize rather than surge. Just along the coast from Sandbanks, Canford Cliffs is experiencing an even sharper correction. The Times reports a year-on-year drop of roughly 9%, making it one of the steepest declines among luxury postcodes in the south. Once a magnet for wealthy downsizers and London escapees, the area's high-end flats and detached homes are now oversupplied. Many properties purchased during the 2020 to 2022 boom are being relisted at reduced prices as owners confront mounting mortgage and maintenance costs. Estate agents describe the market as reality check mode, with buyers negotiating hard and cash offers dominating. While demand for coastal living remains, the frenzy has cooled, and the gap between asking and achieved prices is widening. Local experts suggest that Canford Cliffs is simply adjusting back to sustainable values after years of inflated growth. Still, with prime homes sitting unsold for months, even long-time residents admit the air of exclusivity no longer guarantees immunity from wider market forces. Huddersfield recorded the largest property price fall in 2024, dropping 6.6%, according to the Times, and that weakness has carried into 2025. The town's affordability advantage is being eroded by falling demand and rising supply, especially among buy-to-let landlords who are selling up after years of tightening rental regulations. Detached homes and modern flats have seen the sharpest reductions, with many owners slashing prices multiple times to attract cautious buyers. The West Yorkshire market has been hit by reduced migration from nearby Leeds and Manchester, as higher commuting costs offset cheaper housing. Local agents say sentiment remains subdued, with fewer first-time buyers able to secure loans. While Huddersfield's fundamentals, solid infrastructure and universities, remain sound, confidence in short-term capital growth has evaporated. Analysts expect the town to stabilize later in 2025, but only after sellers fully adjust to the new pricing reality. For now, Huddersfield represents the northern face of Britain's broader market slowdown. In London, Southwark has become a bellwether for the capital's cooling market. After years of steady growth, the Times notes that this borough recorded price declines through 2024, feeding into ongoing softness in 2025. The area's mix of modern riverside apartments and Victorian terraces once made it one of London's most sought-after investment zones. But with mortgage rates stubbornly high and landlords exiting the market, listings have surged. Many sellers are cutting prices by 5 to 8% within weeks as competition intensifies. Even properties near transport hubs like London Bridge and Bermondsey are sitting unsold longer than usual. Analysts cite the combination of high service charges, rising ground rents, and cooling overseas interest as the main drivers of decline. While Southwark's cultural and business appeal remains strong, its housing market is now clearly in retreat, a sign that even inner London's resilience has limits. Investors are watching closely, wary that further declines could spread to neighbouring boroughs next. According to Money Week, London remains the weakest performing region in the UK housing market in 2025, with average asking prices down about 1.4% year-on-year compared to the national average decline of 0.1%. After a decade of relentless price growth, The capital is now feeling the combined impact of higher mortgage rates, falling investor confidence, and a record number of landlords. Many landlords are selling off their portfolios. Demand has softened, particularly in the outer boroughs, where homeowners who bought during the pandemic boom are finding fewer buyers willing to match previous valuations. With rental yields tightening and affordability at its worst in a generation, more sellers are cutting prices just to attract offers. Agents across London describe a price reset rather than a crash. But data shows the capital's property market is clearly under pressure. While cash buyers and overseas investors are slowly re-emerging, they are driving harder bargains, signaling that London's property dominance is finally being challenged. Rightmove data from mid-2025 showed new seller asking prices in Inner London dropped by 2.1% in July alone, reinforcing the trend that the city's core property zones are losing momentum. Traditionally insulated from wider market turbulence, areas like Camden, Islington, and Southwark have now joined the slowdown. Rising interest rates have cooled both domestic and international demand, while higher service charges and ground rents have discouraged buy-to-let investors. Estate agents report longer selling times and a growing number of price reductions within weeks of listing, something rarely seen in these premium postcodes before. Despite continued demand from professionals and foreign buyers, overall affordability and taxation have turned London's heart into a buyer's market. Analysts suggest this may mark a structural shift rather than a temporary dip, as rising living costs and remote work trends continue to reduce pressure on central housing. The correction might be moderate in numbers, but psychologically, it represents a major market reset. Once the symbol of global wealth, Kensington and Chelsea is now leading London's property decline. The Financial Times reports prime values dropped by 15.1% year-on-year in March 2025, the steepest fall since 2013. This dramatic correction follows years of stagnation in the luxury sector, compounded by higher borrowing costs and a shrinking pool of international buyers. Russian, Chinese, and Middle Eastern investment, once key to the area's strength, has slowed significantly, while domestic demand has dried up due to strict affordability checks. Many high-end homes now linger on the market for months, forcing owners to accept discounts previously unthinkable in this postcode. Analysts say oversupply at the top end has collided with waning global appetite for trophy properties. Despite its prestige, Kensington and Chelsea is undergoing a full-scale repricing phase. Sellers who used to wait for the right buyer are now negotiating aggressively, signaling that even London's most exclusive enclave isn't immune to economic gravity. Like its neighbour Kensington and Chelsea, Westminster is experiencing a major revaluation of its property market. The Financial Times highlights significant price falls across the borough, driven by reduced investor activity and stricter lending conditions. Prime properties near Mayfair and St James's are seeing offers come in 10 to 15% below asking price, a level of negotiation unseen since the Brexit years. Once fueled by foreign capital, Westminster's luxury market has cooled amid tighter global regulation and uncertainty around property taxation. Domestic demand remains, but the pool of qualified buyers has. Prices have shrunk dramatically as mortgage costs rose. Estate agents report that many sellers are relisting homes multiple times, adjusting prices downward to attract attention. Even historically resilient pockets like Pimlico and Soho are showing softness, with rental yields failing to offset ownership costs. Analysts suggest that while Westminster will always command prestige, its property market is finally aligning with economic reality, and the correction isn't over yet. According to the Financial Times, Hammersmith and Fulham has joined the ranks of London's cooling prime boroughs, with notable declines in 2025 as both investors and homeowners face mounting financial pressures. Once a favorite among affluent professionals for its riverside properties and easy access to central London, the borough is now witnessing a sharp rise in listings as landlords exit the market. Homes that once attracted bidding wars are now sitting unsold for weeks, prompting price reductions averaging 5 to 8%. Rising service costs and energy bills have further weakened affordability, particularly for large Victorian homes that require constant upkeep. The ripple effect from neighbouring Kensington, Chelsea, and Westminster is clear. The entire West London corridor is undergoing repricing. Despite this, Hammersmith and Fulham remains desirable for its schools and transport links, meaning long-term fundamentals are intact. But for now, the balance of power has shifted decisively from sellers to buyers, marking 2025 as a reset year. Across the southwest of England, property prices are finally easing after years of pandemic-driven growth. Rightmove reported annual price falls in October 2025, reflecting a broader slowdown in demand across counties like Devon, Cornwall, and Somerset. The region's housing boom, fueled by remote working and lifestyle relocations, has cooled as hybrid work fades and affordability tightens. Mortgage rates have priced out younger buyers, while older homeowners are downsizing or moving back toward urban centres. Many second homes owners, particularly along the Cornish coast, are selling. As local councils impose stricter taxes on vacant properties, estate agents describe the market as correction mode. Homes are still selling, but only after significant price adjustments. The combination of reduced demand, high living costs, and oversupply in tourist areas has pushed prices down for the first time in nearly a decade. For opportunistic buyers, 2025 may mark the start of renewed affordability, but sellers are bracing for further drops. The Southeast, historically one of the UK's most expensive and stable markets, is now showing clear underperformance compared to the rest of the country. Morningstar data highlights annual price declines across 2025, as high mortgage rates and elevated living costs squeeze affordability. Counties such as Surrey, Kent, and Oxfordshire have seen growing inventories of unsold homes, with average discounts widening month after month. The commuter belt, once buoyed by London's overflow demand, is now facing slower migration and fewer cash-rich buyers. Many households that stretched budgets during the pandemic boom are now refinancing at higher rates, forcing some to sell below peak valuations. Estate agents note that while family demand remains strong in principle, rising transport costs and stagnant wages have shifted sentiment. The Southeast's softening market serves as a warning. Even affluent regions are no longer immune to macroeconomic headwinds. The safe haven perception is fading, replaced by cautious negotiation and price realism. The east of England, covering counties like Essex, Cambridgeshire, and Norfolk, is experiencing weaker momentum and measurable year-on-year price declines. Once one of the fastest-growing regions post-pandemic, it is now slowing as affordability pressures catch up. Households who relocated from London for more space during lockdowns are now facing negative equity risks in some areas. Agents in Cambridge and Colchester report rising stock levels and fewer viewings, forcing sellers to trim asking prices. The rental market remains strong, but buy-to-let investors are selling as higher interest rates erode profit margins. Even rural areas, long shielded by limited supply, are showing cracks as demand cools. Analysts predict the East could see further declines into 2026, especially if interest rates stay elevated. While long-term prospects remain solid thanks to employment growth in tech and life sciences, the short-term outlook is clear. The East's housing surge has run out of steam, and a correction is firmly underway. The market's shifting fast. Don't get left behind. Subscribe now to stay ahead of every price drop, insider trend, and property opportunity before everyone else sees it.